Hi, welcome to this short discussion on trends in European private equity. I'm Chris Sullivan, a partner here in our London private equity team, and I'm delighted to be joined by one of my partners, Sonia Gilbert, who's head of our incentives practice, and Ximin Li, a senior associate here in the private equity team in London. We're going to spend a few moments thinking about some key trends in management incentive plans. You might hear them referred to here as MIPs. Those are particularly areas of focus at the moment as we see clients thinking about resetting the economics of their MIPs or broadening out the participation, so expanding the number of people, perhaps the number of geographies through which people are participating in the programs. Min, perhaps we'll start with the resets on the economic side. What are we seeing there in terms of people changing the structure?
Oh, thank you, Chris. I think a lot of the sponsors are increasingly looking to reset their MIPs, as you say, and this could be for a range of reasons. One of which is that the plan is simply not fit for purpose anymore, and that's because of the really difficult trading conditions that a lot of these portfolio companies find themselves in. So, for example, the hurdles that attach to those shares in the MIP no longer are achievable. But it could also be because there's a change to the business plan of the portfolio companies, and so the return profiles have changed and the MIP needs to reflect that. One other reason could be because the portfolio company has entered into a bolt-on acquisition, and so you've got a new MIP team coming in, a new management team coming in that needs to also be incentivized and integrated into that same MIP. But I guess regardless of the reason why you're seeking to reset the MIP, you should really be thinking about being proactive about it if you know there is a driver for doing so. And we've definitely seen loads of sponsors proactively thinking about aligning interests as they go through this really difficult period. I guess in terms of the different ways in which you could reset the MIP, there are many options. And just to pick on a few, you could, for example, have the sponsor transfer some of their shares to the management team, and in doing so, redesignate those share classes. You could also issue new shares. So, for example, look at the same level in the structure and issue a new class of shares, or look at a different level of the structure and issue shares there. I think the third way you could do it is to basically keep the share classes as they are, but reset the existing hurdles so they're effectively lower and therefore more achievable for management. And I guess you'll be thinking, well, so many different ways of doing this, which one should I choose? And often you'll think about tax as the first consideration, but you should also be thinking about things like consent rights. So, whose consent do you need? And if you need someone's consent, is that going to be achievable? I think one other point to note is whether or not your approach is targeted to specific members of the team, or if it's a broader based approach which would affect the rest of the management team equally, so whether it's a targeted or a non-targeted approach to resetting the MIP. And one final point, I think, Sonia, you'll probably agree, you want to make sure the structure is really clean and doesn't basically disrupt an exit. So what you don't want is to have many classes of shares sticking out at different levels of the structure and then get to an exit and realize it's a huge headache to basically navigate through that. But I guess ultimately, it's definitely a very effective way of seeking to optimize business outcomes, especially given the trading environments, but definitely not the only way. And Chris, I think you've come across the broadening of participation as a different way of doing that as well.
Yeah, that's right. Often in conjunction with that reset of the capital structure or reset of the economics, we see an expansion of the numbers of participants who are invested in the incentive program. That might be for a variety of reasons. It may simply be because the business is focused on sharing the economic reward from the business's performance across the business. It may be because they want to expand into new geographies and so want to incentivize and drive a team in a particular country. It may be, as you say, as a consequence of a bolt-on acquisition, bringing in a new team. Or indeed, it may be because of the legacy of the target. So historically, we've seen a number of public to private transactions where public companies are acquired by financial investors. We expect when the PE M&A market returns that we will see more of those. And in some of those businesses, there is often a broadly held LTIP or STIP scheme, meaning that not only do the senior executives or the C-suite managers of the business participate, but also a range of people operating across the business are invested. That in a retail business, that could extend to the managers of the stores, people working in the stores, all the way up to the board level executives. But with that, a note of caution in that it does tend to come with incremental complexity. So you do have to be careful, to your point earlier, that you're not creating a structure which is unwieldy at exit. And that's why we see not only schemes structured through the ownership of shares, which is generally the preference because it tends, in the European context, to deliver a capital gains tax return, but also through people thinking about the use of employee benefit trusts or nominee schemes, or indeed option schemes or phantom schemes or other programs which might provide the economic incentive even if not optimizing the tax outcome. And Sonia, I know we work closely together on those schemes, and it's great to have your support there. Are you seeing other programs or other trends at the moment in incentives that you'd like to touch on?
Yeah, absolutely. And we were obviously talking about some of this before today. I think we are really seeing people look at this as an opportunity to say, look, if I'm looking at resetting my MIP, if I'm looking at maybe broadening out my MIP, what else do I need to think about? And one trend that we have been seeing is more, not so much once the MIP is in place necessarily, but really at the point of acquisition. Because when you look at what's happening in the market and you think that often acquisitions are quite heavily debt financed, and obviously debt finance at the moment is more expensive, it's more difficult to come by, it's not always possible to simply buy out a seller. And so one of the things we've been seeing is effectively the seller being rolled over into the MIP, or MIP shares at least, alongside buyer and management, which leads to an interesting sort of dynamic when you've got the three parties involved on an ongoing basis. Now, I'm sure if you're sell side, you're thinking, well, we want to have some input into the MIP and how it operates because this is impacting our economics too going forward. Whereas when you're on the buy side, we tend to see people being quite resistant to having seller input on the terms and how it operates, and simply saying, sit alongside us and you are impacted in the same way as us. But that's really looking at when you come into the structure. Quite separately, we've been seeing people think a lot about ESG, so environmental, social governance, really what you've seen people do in the listed company environment, where there's been, for 3 or 4 years now, a real drive to try and link people's pay to ESG metrics that are applicable to the business. So it's still very much, have we got alignment with the business and the business drivers? And I think in the private equity context, there's a recognition that actually, if you've got ESG KPIs, why not use those as part of the incentivization that you've got for management and maybe even broader employee participation? There is a lot, I think, that can be learnt from, frankly, what the listed companies have already thought about, and we've all learned, which is what are the right types of metric, what makes sense for your business, how do you measure them, and also how achievable are they over the shorter or the longer term. And I think one particular issue when you're thinking about MIPs is obviously, as you said, Chris, many MIPs are structured to give capital tax treatment, and you don't want to corrupt that by changes that you make to the MIP. If you start adding in performance hurdles linked to something like ESG, you need to be very careful that you're not somehow diluting or corrupting that tax treatment. And so we are seeing people think carefully about whether the MIP is the right place for those ESG targets, or whether actually they should be put somewhere like a short-term incentive or annual bonus. And then finally, I think people are really thinking about the sort of medium to longer term. And although the market obviously at the moment isn't conducive to IPOs, people are thinking about, well, what should my IPO trigger look like in relation to my MIP? As we know, obviously, an IPO is one of the common triggers for a MIP to deliver value to management. And I think the debate for people at the moment is, should the IPO, if you like, be a complete trigger where the MIP, as is common for sort of European MIPs, effectively disappears, delivers value, you roll over into the new listed company shares you sell down over time? Or should you go more of the US approach of actually the MIP stays, sits alongside the sponsors, and you are still subject to that MIP for a period of time post-IPO? So it's going to be very interesting to see where people go, and certainly a lot that people are debating.
Well, thank you, Sonia. That was hugely interesting. And actually that convergence between North American practice and European practice is something we see not only in incentives, but also on M&A terms and in financing. And it's very interesting to watch that continue. This area clearly is one that's continuing to evolve. Sponsors are focusing on it while they are addressing issues in their portfolio, and while M&A volumes for new deals remain suppressed, at least by historic standards. So that's been a really interesting conversation. Thank you very much, Sonia and Shimin, for your thoughtful insights.
Thank you.
Thank you.